Why $5,000 a month is a misleading number in the United States. At first glance, a monthly income of $5,000 appears solid. For many people outside the United States, it sounds comfortably middle class, even affluent. However, for a significant portion of Americans, earning $5,000 a month does not translate into financial security, savings, or long-term stability. The first reason lies in how income is commonly misunderstood. In the United States, salary figures are almost always discussed in gross terms, not net income. A $5,000 monthly salary is typically quoted before any deductions. Once federal income tax, state income tax, Social Security, and Medicare are applied, the actual take-home pay drops substantially. For most workers, net income falls between $3,700 and $4,000 per month, and in high-tax states, it can be even lower. This gap between perceived income and usable income is not merely a technical detail, it shapes financial behavior. People plan their lifestyle, housing, and consumption based on the larger gross number, while their expenses are paid with the smaller net amount. This structural mismatch creates chronic pressure on household finances from the very beginning. Geography further complicates the issue. The United States has one of the widest cost of living disparities among developed economies. A $5,000 monthly income in a rural Midwestern town may provide a modest but stable life. The same income in New York City, San Francisco, or Los Angeles places an individual close to the lower end of the income distribution relative to local expenses. In high-cost metropolitan areas, housing alone can consume more than half of net income. When a single expense absorbs such a large share of earnings, the remaining income becomes insufficient to build savings or absorb shocks. The income level itself is not low in absolute terms, but it is inadequate relative to the environment in which it must function. Another critical factor is historical context. Over the past several decades, wages in the United States have grown slowly, while costs for housing, healthcare, education, and childcare have increased rapidly. Despite this, cultural expectations around what constitutes a middle-class life have remained largely unchanged. Many Americans earning $5,000 a month believe they should be financially comfortable because similar incomes provided stability in previous generations. This disconnect between historical expectations and present realities produces a persistent sense of financial failure. Individuals blame themselves for outcomes that are largely structural. They assume mismanagement rather than recognizing that the economic baseline has shifted. Finally, the U.S. economic system is designed around continuous cash flow rather than accumulation. Most households rely on steady paychecks to meet recurring expenses. When income merely covers obligations, there is no margin for error. A single disruption, job loss, illness, reduced hours can rapidly destabilize finances. In such a system, $5,000 a month is not inherently insufficient, but it is often not resilient. Fixed costs, the structural drain on middle-income households. The second reason many Americans earning $5,000 per month feel poor lies in the structure of their expenses. Fixed costs dominate household budgets, leaving little flexibility. These costs are difficult to reduce quickly and continue regardless of income fluctuations. Housing is the most significant fixed expense. In many regions, rent or mortgage payments consume between 40% and 60% of net income for individuals earning around $5,000 per month. Financial guidelines typically recommend keeping housing costs below 30% of income, but this threshold has become unattainable for millions of Americans. Once housing exceeds this level, the financial system becomes fragile. Any additional expense, utilities, repairs, insurance, increases strain. Downsizing is often impractical due to limited housing supply, lease obligations, or family considerations. As a result, housing costs become a permanent constraint rather than a variable choice. Transportation is another major fixed cost. In much of the United States, owning a car is not optional. Car payments, insurance, fuel, maintenance, and registration together often total $800 to $1,000 per month. While each component may seem manageable in isolation, their combined impact is substantial. Healthcare introduces a different type of fixed cost, one that is both recurring and unpredictable. Even insured individuals pay monthly premiums, deductibles, and co-payments. Medical expenses do not scale neatly with income and can spike unexpectedly. For households with limited savings, a health event can instantly erase financial progress. Beyond these major categories are numerous smaller fixed expenses, Internet, mobile phones, utilities, subscriptions, and insurance policies. Individually modest, collectively they create a dense web of obligations. Once these costs are established, reducing them requires significant lifestyle changes, contractual renegotiations, or geographic relocation. The defining characteristic of fixed costs is that they reduce financial optionality. When most income is pre-committed, individuals lose the ability to adapt. They cannot easily save, invest, or absorb shocks. Financial stress arises not from extravagance but from rigidity. Consumption norms in the middle-class lifestyle trap. Beyond structural costs, behavioral and cultural factors intensify financial strain. American consumer culture strongly associates personal success with visible consumption. Housing quality, vehicle choice, technology, and leisure activities function as social signals. As income increases, expectations rise accordingly. This phenomenon, known as lifestyle inflation, ensures that higher earnings do not translate into surplus. Instead, additional income is absorbed by upgraded living standards that quickly become normalized. The middle-class lifestyle trap is particularly powerful because it is socially reinforced. Individuals compare themselves to peers rather than objective benchmarks. Choosing lower-cost options can feel like social regression, even if it improves financial health. Credit cards amplify this dynamic. They reduce the immediate psychological cost of spending by separating consumption from payment. High interest rates, often exceeding 20%, turn short-term convenience into long-term financial drag. Minimum payments mask the true cost of debt, creating the illusion of manageability. Debt introduces not only financial but cognitive constraints. Stress and anxiety impair decision-making, leading to avoidance and short-term thinking. Instead of strategic planning, individuals focus on meeting immediate obligations. Importantly, many people in this situation are not financially irresponsible. They are responding rationally to incentives embedded in the system. Easy credit, social pressure, and normalized debt create an environment where living beyond one's means feels ordinary rather than risky. The absence of financial buffers and systemic risk exposure. A defining feature of financial insecurity among middle-income Americans is the lack of buffers. Emergency savings are rare. Surveys consistently show that a large portion of households cannot cover a $1,000 unexpected expense without borrowing. Without buffers, every disruption becomes a crisis. Job loss, reduced hours, medical bills, or family emergencies immediately threaten basic stability. The issue is not income volatility alone, but the absence of accumulated slack. This vulnerability is exacerbated by the structure of employment. Benefits such as healthcare and retirement are often tied to jobs. Losing income frequently means losing protection at the same time. For someone earning $5,000 per month, the margin for error is already narrow. Financial fragility also limits long-term planning. When survival depends on the next paycheck, saving for retirement or investing feels abstract and unattainable. The future is consistently sacrificed to meet present needs. Root causes and structural conclusions. Americans earning $5,000 per month are not poor in a traditional sense, but many are financially insecure. This condition emerges from the interaction of several forces: net income erosion, high fixed costs, consumption norms, debt structures, and systemic risk exposure. The system does not require individuals to fail, but it does little to protect them from instability. Financial security is achievable, but only through deliberate resistance to structural pressures. This requires controlling fixed costs, avoiding high-interest debt, building emergency savings, and understanding how income functions within the broader system. The central conclusion is not that $5,000 per month is inherently inadequate. Rather, it is insufficient to guarantee stability in an environment where costs are rigid, risks are individualized, and financial education is limited. Understanding this reality shifts the narrative from personal failure to structural awareness. Only with that understanding can individuals make informed decisions and regain control over their financial trajectory.